It's March 16th, 2023, and unless you've been living under a rock, you certainly know that banks are having some major problems. This Facebook post here shows screenshots of stock value declines at a few banks on March 10th, and as we all know, on March 10th, Silicon Valley Bank collapsed. Now, what's causing the problem at these banks is the bond portion of their portfolio. And I think that there's more going on here than what most people are talking about. So I'm going to share that with you and how banks have ended up in this situation. As we know, banks don't hold deposits dollar for dollar in cash. Instead, they engage in what we know of as fractional reserve banking, where they hold a little bit in cash. In the United States, that's regulated to at least 10%. And then with the rest of deposits, they use that to make other investments that they can earn returns on. And a portion of what they invest in is bonds. Now, the amount that they hold in bonds changes from bank to bank. I would assume that at all of the major banks, they're all holding a similar amount in bonds. And bonds are the first place they tap into when they need to pull liquidity to cover customer deposits that are being withdrawn. So when banks need money beyond their reserves, the first portion of their portfolio that they will look into is the bond portion. That is because, generally speaking, this is less volatile and more liquid than other investments that they might make. So if they're investing in, say, real estate or startup businesses or something like that, those investments may not be liquid at all times, right? With bonds, they can pretty much liquidate those with the touch of a button. And again, usually bonds are not very volatile. So that is, logically the best place where they can go to pull liquidity from the investments that they've made. Now, here's the thing. Let's look at the performance of bonds over time. And right here, what I'm doing is I'm pulling up 10-year treasuries, so 10-year US Treasury bonds. There are other types of bonds out here, but this is, again, probably the largest asset class within bonds, or the largest sub-asset class within the asset class of bonds, 10-year treasuries. And I'm using this just kind of as a proxy to discuss the whole bond market. But again, of the bond portion of a bank's portfolio, intermediate term treasuries, 10-year treasuries, maybe even longer, are probably going to be the biggest holding. We're just going to be looking at 10-year treasuries for simplicity. Now, I've got the time period here for 1981 to 2020. So this is a 40-year time period. And if we look at the portfolio performance of 10-year treasuries, we can see right here that things pretty steadily go up. So they return compound annual growth rate over this period of 8.03% with a max drawdown of negative 10.87%. So when you look at this, it looks like bonds just steadily go up without much downside risk. Now, here's the thing. Quantitative investors look at this and say, hey, these things rarely go down. They're very non-volatile, or they're not very volatile. There's not a lot of volatility in these things. Why don't we lever them up? Okay, why don't we lever this up? Why don't we double leverage it? Then we get a 16% return, and our max drawdown is only 22%. So things are pretty stable. We don't have to worry about margin calls or minimum collateral if we're using futures for this strategy. We can essentially lever it up. And there's that word lever. Leverage is what causes financial calamities, like the great financial crisis of 08 and 09, and what we're seeing here in bond markets. So back in the early 2010s, quantitative investors, myself included, were looking at bond markets and we're seeing this historic performance of, prior to 2010, the last 30 or 40 years, and we're seeing, hey, these bonds constantly return stable numbers, stable growth with minimum volatility. And we're thinking, why not lever it up? This strategy is more known as risk parity. That would kind of be the textbook definition of this, which is fundamentally look for low volatility and find ways to lower the volatility of a portfolio and then lever it up. And with low interest rates, this could be done. It could be done with margin very easily. It could also be done with futures contracts where these things are not subject to interest. But again, there is going to be some frictional costs in futures, just as there is frictional cost in trading the bond holdings with margin leverage, but there might be a little bit more frictionality in the futures contracts. Bottom line is, this could be done with very little interest cost, very little carrying cost, and it looks good here when you're looking at it through this period. If you're looking at it in the early 2010s, which coming out of the great financial crisis, is when a lot of investment managers at banks were looking at this stuff, it looked like a great strategy because here through 2008 to 2010, it went up. So let's just put the S&P 500 on here. No, not going to do that. We're going to put a benchmark of the S&P 500 on here, and I'll run it through this whole time period as well. And we can see the S&P 500, has clearly outperformed bonds, but it's done so with some big drawdowns. And if we just isolate this to say, well, let's isolate this to 2009 and 2000, right? So a 10-year period known as the lost decade here, the S&P 500 on a total return basis even had a 10% loss. 10,000 invested in the S&P 500 at January 1, 2000 to the end had a loss, but through the great financial crisis, we can see bonds returned 6.52% annually through that whole decade. Had really no problem through the great financial crisis and looked good. So as an investment manager, particularly where you have the ability to hold leveraged investments, if you're looking at things through this time period at the end of the great financial crisis, you're looking at this and saying, hey, bonds look great. They've performed excellent for the last 30 years. They consistently go up. They really rarely go down, as opposed to stocks, which have high volatility and high drawdown, seeing two major drawdowns there in the 2000s. You're looking at this and going, shit, I'm just going to lever this up and take on the risk of leverage. Okay, and that works good until it doesn't. So, we're looking at this here in the chart I had was through the end of 2020. And again, the bonds look good. They look like they're going up very stably. I'm going to remove the benchmark here. And again, we see the portfolio going up. And the bottom line is here, when you're looking at these numbers, especially if you're looking at it in 2010 or even in 2020, it just looks like you can leverage this up with 2x leverage. Your max drawdown's 22%. Like, what the fuck do you have to lose? There's no risk in this. Okay, we can look at the drawdowns. This is really interesting. We see the max drawdown here in the late 80s of 10.87%, but things rebounded pretty quickly. So there's really never been a big drawdown in bonds, at least for the last 30 years. And investment managers at these banks are saying, hey, this looks really good. Now, we can lever this up. And then, when they look at their leverage rates, or when they're looking at models to assume how much they can leverage it, they look at this and say, okay, bonds can go down 10%, 11%. Let's just be cautious here, and we'll double this and say that bonds go down at a max 20 or 22%, and we will build our leveraged portfolios assuming that is the max that bonds can go down. All right, so we're going to double it. We're going to be super cautious here and say bonds can only go down 20%. And if that happens, our portfolios are still built to where we don't have a problem. Okay, well, now let's look at what's happened going forward here beyond 2020 in the last 2 years. 2021 and 2022, we've seen that. We now see that bonds can go down, and they can go down a good bit, and they can hold that for a period of time. They can go down for a while as the Federal Reserve is raising interest rates. And I think, again, when people were researching these investments and coming up with their investment theses for leveraging bonds, the thesis was, and I know this because I was researching this space as well, and I was in these circles where people are researching this, the thesis was that the Fed's just going to keep bond rates low, or not bond, interest rates low for a long freaking time, right? In Europe, they're keeping them low. In Japan, they're keeping them low. So fuck it, in the United States, interest rates are basically going to be damn near zero, right? So there's not a problem in the bond market. That was the thesis. Well, now the Fed has cranked up interest rates. We're seeing the bonds decline. And now, if we go to the drawdowns here on the portfolio, holy shit, things start looking bad. The bonds have had an actual drawdown of more than 10%, nearly doubling it, which that is basically teetering on the threshold of the leveraged financial models that investment managers have used, right? So like I said, they thought they were being cautious by saying, all right, let's just assume the worst case scenario is bonds have a drawdown of 2x what it has been historically and build that into our portfolios. And wow, holy shit, that is actually happening now. So that is causing a huge, huge problem. Okay? Now, here let's go back to the actual bank's portfolios and talk about those. When people are, withdrawing the money from the banks, they need to liquidate their portfolios. But now they need to liquidate a portion of their bond portfolio to come up with the cash. But now the portion of their bond portfolio is overmarked, right? So they cannot go to the market and get what they've got on their balance sheet. So if a bond is worth, in round numbers, $1 million on their balance sheet, and they need to go to sell it, oh shit, it's not worth $1 million anymore. It's only worth $950,000. That's what they've got to sell it for. And then the stock market sees that, and investors see it and realize, oh my, there's, the problem here, and this balance sheet's not as good as it was. Therefore, our stock value based on fundamental analysis is not as high. People start selling the stocks. And then you leverage this up and you account for all the leverage, and then things really, really start having a problem. All right, so it's the leverage on these bond portfolios and the fact that they're marking them to market that's really creating a problem. Now, no one is talking about the leverage on the bond portfolios, and I don't think that many of the mainstream financial commentators really recognize or understand this. I think this is something that's being overlooked. So that said, what do I think about this, and where do I think things are going? Okay, so first and foremost, I'm not afraid of some major calamity to where we can't get cash out of the bank. Okay, bonds can be liquidated. And the banks can cover customer needs. And I also think the federal government would step up to ensure that things can be liquidated and ensure that there's liquidity and that banks can cover cash. So I'm not worried about that. But what this really means is that for bank stocks that are engaged in leveraging bond portfolios, which I believe is probably all of them, because like I said, in the early 2010s, from say 2011 to 2016, this was really, really hot topic in the quantitative investing world. And no doubt this kind of filters back into or makes its way into the bank's portfolios. So I believe that they're probably all engaged in this, that they've got a lot of bonds on their portfolio, on their balance sheet, that are really overvalued. So when customers go to withdraw from the bank and they need to liquidate the bond portion of their portfolio, the banks need to cover those customer deposits, then they can do it and they can get cash for it, but the stock price is just going to fall rapidly, right? So what I'm saying is I'm not worried about cash issues at the bank, but the stocks of these banks are going to and could fall incredibly rapidly if these banks need to start selling their stocks at a loss. And there is another factor here. I'll just kind of mention it because I really didn't touch on it. My big point that I wanted to make is that bonds leverage their holdings, and they're doing this at what I believe is a rate, we don't have the hard numbers on it, but I believe that they're doing this at a rate that is much higher than many people recognize. But also they've, been taking out these bonds at times when interest rates are low, and as the interest rates rise, well, now their bonds are lower, have lower value. If there's not, bank runs, or not bank runs, but if people are not withdrawing at a high level, their bonds will roll over, the portfolios will be reinvested at higher interest rates. It's not a huge problem, but the leverage is really causing the problem behind it. So on that note, that's really, what I see is the problem. What is the problem here? And what I think is going to happen, I think bank stocks are in for a kind of whirlwind of slap in the face, and there probably will be more banks collapsing, but as a retail consumer or retail banker, I'm not worried about this, in the sense that I'm not going to be able to get cash out of the bank. Yes, my portfolio is going to have a drawdown for some period of time. No, I don't like it. But that is what's happening out here. And I think there is a big headwind ahead, big headwind ahead for banking stocks. On that note, guys, I hope you found this video helpful and insightful. If you did, be sure to do me a sweet one. You know the drill. Smash that like button. Do yourself a sweet one. Hit that subscribe button. I'm calling it a wrap and signing off on this.